So although we're primarily known for our defined benefit plan, we do offer several other services. So I thought I would just touch on those briefly. We purchase healthcare, as I mentioned, for about 1.5 million people. We contract for that with 6 HMOs and one health plan that's a third-party administrator for the self-funded plans that we have. In 2015, we anticipate spending about $8 billion on purchasing health benefits. Our focus is very much on cost containment while at the same time preserving the quality of health care. So some of the things we've done recently were increasing the number of HMOs in the plan, trying to spur competition. Our negotiations for the 2015 calendar year were very successful. We cut premiums by 3% for almost 600,000 members and held the line for many more. Another service we offer is a deferred compensation plan that local agencies can contract for. It's like a 401k plan. We have about 750 agencies participating right now with about 27,000 members. And with the passage of PEPRA, we really see that that program will gain in importance as the PEPRA members have lower benefits. That supplemental income will be even more important. We have a long-term care program open to all California public employees and their families. This is not an employer-paid benefit. It's self-funded through premiums. And then the last program I wanted to mention is what we call CERBIT. It's the California Employers Retiree Benefit Trust, and provides California public employers an investment vehicle for pre-funding post-retirement health care benefits. We agree with the governor that pre-funding retiree health care is fiscally prudent, and we're hopeful that with their renewed attention on this issue that our fund will continue to grow. It's a very cost-effective way for employers to pre-fund. We have about 455 participating employers right now. So going back to the subject of defined benefit plans, I wanted to just make a few points about the value of this type of plan, and Jack touched on it as well. Defined benefit plans have several really valuable features. They're critical for recruiting and retaining a strong public sector workforce, and we think this will be even more true as millennials become a greater part of the workforce. Research is showing that millennials, more than any other generation, are very interested at an early stage in life in financial security, and very interested in what the benefits are when they start their jobs. As Jack mentioned, DB plans are generally preferred to 401k type style plans, because in the 401k plan, the individual bears the risk from investment loss, and the income at the back end at retirement isn't as predictable. DB plans have also shown to be more cost-effective. There's a study by the National Institute on Retirement Security that found that if you take the same benefit at retirement, it costs 48% lower to fund it through a defined benefit plan than it does through a 401k type plan. And that's really in large part because of the pooling of the actuarial risks, the long-term investment horizon and the diversification, and the lower professional fees. And then the last feature I wanted to mention about defined benefit plans is the significant economic footprint that they have in our state and communities. And we do an annual report on that. It's in your packet. And then we also, for each of the members, we prepared a handout for you on what the direct investments, CalPERS investments are in your districts, and what the economic impact is of the benefit payments in your district. So those are customized in your packets. And then I'll turn it over to Ted shortly. I just first wanted to talk about the health of the fund, the financial health. So in the pension industry, the health of a fund is generally defined by what we call the funded status, and that is the calculation of the assets as a percentage of accrued liabilities. And that number fluctuates over time depending on how the market's doing and various demographic and actuarial factors. So as of the end of the 2014 fiscal year, the CalPERS fund on average was 77%. That's across all the different funds that we manage. And as you can see from the chart that's on page 9, our funded status fluctuates quite drastically over time. It's been as low as 55%, and it's been as high as 138%. And it's important when you look at funded status to think about it over a several-year period, and that it's should be viewed as a gauge of progress and not as a definitive conclusion at any point in time. We do an annual report that we started doing 3 years ago on our funding levels and risk, and that's available on our website. And what we talked about in our most recent report is that at this time kind of in our history, there are both actuarial and market factors that could impact the funding risk. Not immediate danger, but important things to monitor. So on the actuarial side, for example, public employees are living longer, and that's a phenomenon throughout the country, not unique to CalPERS. But because of that, our board recently adjusted our mortality assumptions last year, and that resulted in the employer contribution rates going up. Another actuarial or demographic factor is what we call the maturation of the workforce. And what that means is that there are fewer active workers in proportion to the retirees, so there are less people actively working to support the retiree benefits. And then on the investment side, given the low interest environment that we're in, we've been shifting our assets away from fixed income type investments and more into equity to make sure we meet our expected rate of return. And the result of that is some increase in the risk of our assets and volatility. So given these conditions, our fund is more sensitive to equity risk in the past. So given both the actuarial developments and the markets, we're continuing at CalPERS to look at additional mitigation strategies to reduce risk in the fund, and we've been seeking stakeholder input on that. No decisions have been made. We'll be looking at it over the next few months and keeping everyone informed. So you see how important the portfolio is. So at this point, I think I'll turn it over to Ted to give you an update on how the investments are doing.
Great. Thank you so much, Anne. Good afternoon, Chairman Pan, Chairman Bonta, members of the committees. Thank you for having me. I'm pleased to be here today. This is my first appearance before your committees. I was appointed Chief Investment Officer last September. However, prior to that, I oversaw our real assets program since 2007. I'll try to be brief, and I'll start with an overview of the investment office operations. You have some charts in your packages. Starting first with the chart on our mission and vision statements. And our mission, the mission of the CalPERS Investment Office is important to underscore. It's to manage the investment portfolio in a cost-effective, transparent, and risk-aware manner in order to generate the returns to pay the benefits to the beneficiaries that we've made these promises to. Our vision statement is a very good framework to introduce how we operate. We're guided by a set of investment beliefs that the investment staff and our board worked together for a 2-year period to promulgate and adopt just about a year and a half ago, and that set of investment beliefs are in your gray binder. Given the size of our portfolio at approximately $300 billion and the long-term investment horizon that we have, that, as Jack mentioned earlier, that looks out 30, 40, 50, 60 years, it is particularly important that we operate in a manner that is premised on repeatable practices, predictable practices, and scalable practices. We care very much about the alignment of interest between CalPERS and our goals and objectives and everyone we do business with. Finally, I want to underscore our belief in transparency, because it is one of the hallmarks of CalPERS as an institution and the CalPERS investment portfolio. From an institutional investor perspective, CalPERS is, if not the leading, and we believe we are, unquestionably one of the leaders in transparency in the reporting of our performance and the reporting of virtually every aspect of how we operate. And we believe that makes us better investors. In terms of the investment office itself, we have a little more than 383 investment staff located here in Sacramento at our building. This staff, together with the leadership team of the office, which is basically divided by asset class. We have 5 senior investment officers who oversee the various asset classes, as well as a chief operating investment officer. We manage this global portfolio all from the 3rd and 4th floors of the CalPERS building on P Street. In terms of the actual CalPERS investments themselves, Ann mentioned approximately $300 billion. To be precise, as of at least the December 31st, 2014 time period, it's $295.8 billion. The fund most recently, in the last fiscal year, was a terrific performance year. We returned 18.4% for the fiscal year that ended in June of 2014. And as Jack mentioned, with respect to the CalSTRS investment portfolio, we look at much longer time periods as being more meaningful. And looking at the past 20 years, CalPERS earned an 8.2% annual return. In terms of some basics of the portfolio, we're well diversified. We have several asset classes, including public equities and private equities, real estate, infrastructure, fixed income. And one of the great principles of diversification is that we seek to offset weaknesses in one asset class by gains in another at any given time period. Closer look at the actual asset allocation, which is the dominant determiner of our risk and return profile. As of December 31st, you can see that we segregate our asset allocation by something we call the growth asset class, and that is the predominant asset class within CalPERS portfolio. It represents 63.4% of the overall portfolio, and that is comprised of our global public equity portfolio, our stock portfolio, and our private equity portfolio, investments in private companies throughout the globe. In addition to that, we have an 18% allocation to fixed income and a 10% allocation to real assets. And you can see some of the smaller asset classes on that pie chart. The 63% allocation to growth represents the highest risk to the overall fund. It's the most volatile portion of the portfolio, primarily because of the nature of the global equity portfolio and the private equity portfolio that comprise that asset class. Turning briefly to a snapshot of our performance versus benchmarks and versus our assumed actuarial rate of return of 7.5. The first glimpse that we provided to the committee is looking at our annual performance versus our benchmarks. And again, we really do not try to, in fact, we look to consciously not emphasize our 1 year or short-term performance, whether it's good or bad. So in a year like this, where we have an extraordinarily strong year, we try not to get too excited by an 18.5% return, because we know there will be other years coming soon that will take some out of that. But we do look at our longer-term returns and compare ourselves to these measures I just mentioned. And there, the 3 and 5 year figures are quite healthy. They're both on a relative and an absolute basis. They're outperforming their benchmarks. Our 10-year number still reflects the impacts of the financial and housing crisis. And then looking at the longer-term return number on this chart in particular, that looks something we call since inception. That doesn't go back to 1932. It goes back to sort of the modern portfolio that we have that includes stocks and bonds and real estate. So it goes back to 1988. So it's a 37-year history of a return of 8.7%. In addition to that, I would like to cover the comparison to our actuarial rate of return chart in front of the committee. And there, what we tried to show is a look at the last 20 fiscal years and how it compares in any one year, any given year, to that assumed rate of return of 7.5, and that assumed rate of 7.5 is shown as the sort of the red bar. What you'll notice instantly is in the 20 years, not one year did we actually achieve a 7.5% return. The returns are far too volatile to have that precision. In this last 20-year run, we were able to achieve returns greater than 7.5% in 14 of those years. In 6 of the years, we failed to meet that rate of return, including in one doozy on the left, fat tail axis on the very left, which is the financial crisis year return. I think reflecting on Mr. Enos's comments earlier today and caution at looking at the last 20 and even last 37 years, that was an environment that Ms. Dasbal mentioned that's quite different than the low interest rate environment that we're in today. So as we look at these returns looking back 20 and 37 years, those were years and time periods characterized by fairly dramatic reduction in interest rates. So going forward, our own projections in our asset allocation work and the projections by our peers such as CalSTRS and other consultants is to expect a much more muted and much more lower return environment for the next 10 years at least as we look at projections. I did want to highlight briefly a couple special programs, targeted programs within the investment office. One, we have a number of investments focused on California particularly, and we report to the legislature our investments in California annually in a report, and that report is also provided to the committees for your review. CalPERS has approximately $25.7 billion invested in California-based companies and projects. Every asset class is represented from private real estate to public equity. The investments span the state. Obviously there's most concentration and heavy concentration in the urban mega centers of California, so the Bay Area and Los Angeles and San Diego. But every California county has some degree of investment, from Del Norte to Imperial County. Perhaps the most visible benefit to the depth of investment in California is the effect on job creation. Our estimates is that our CalPERS investments in California support nearly 1.1 million jobs in the state. Lastly, I wanted to highlight our emerging manager program. It's been a subject of some interest from time to time. Emerging managers, not to dig too deeply into the details, emerging managers are generally defined as newly emerged, newly formed, first-time or second-time fund managers. CalPERS defines emerging managers based on the amount of assets under management that a manager has and how long they've been doing business together. The term emerging managers often includes diverse managers, minority and woman-owned firms. CalPERS has been a leader in this space. We have a very long history of investing with emerging fund managers. Our objective there is to earn and generate appropriate risk-adjusted investment returns, really by identifying early-stage funds, niche strategies, and talent that we can groom to be part of the portfolio for the long term. We have just over $12 billion currently invested with emerging managers, and that represents about 14% of our externally managed assets. Mr. Chairman, that concludes that portion of my presentation. I thank you for your time and your attention. I would be glad to answer any questions.
Thank you, Ms. Dasbal and Mr. Eliopoulos. Any questions or comments from Assembly members or senators? Dr. Pan.
I know we're running a little behind, but I just did want to ask you a brief question. So course, with the aging population, I know we've had some previous conversations that one of the new dynamics is that the amount of money flowing out is now exceeding the amount of money flowing in. Can you speak to the challenges that presents to CalPERS, and just clarify, is it, I mean, this is a situation that's going to go on for a long time, I understand, but this is also, I wouldn't say unique, but at least this is not, the norm has always been the other way around until recently, correct?
Sure. So the maturing of our beneficiaries that Mr. Ospel mentioned is occurring, and the baby boom generation is getting older and retiring. The good news for them, in addition to that, is they're living longer. So what that means for us, though, is a much more a ratio of active to retirees is trending more and more to more retired versus active, and those retirees are living longer. And that does present a challenge to all U.S. pension funds and actually global pension funds dealing with the retirement of the baby boom generation, and recently its effect on CalPERS and other pension funds is what you just alluded to, that we are now, in contrast to the eras of decades past where we had more capital coming in than going out, we are now moving into a time period we'll be paying out more than we're taking in contributions, which puts a focus, as Mr. Ospel underscored, a focus on the investment office's ability to generate cash. And so what that means for the investment office is we're paying particular attention to the components of return in our portfolio. So we're not just looking at appreciation return, we're looking at our stock and our fixed income on our real estate portfolio to really decompose the returns and see how much actual cash yield that we'll be receiving.
Thank you, Mr. Cooley.
Just a quick question. Yesterday's economic scene of the New York Times had a story on American retirement, the impact of professional fees in investment programs that people have in the private sector side. Can you comment a little bit, when you talk about the California rate of return that you're looking at, is that aided in part by the fact that it's administered under fiduciary rules, you're keeping your costs low? Obviously, you have investment contracts, incentive agreements, but in general, CalPERS or your counterparts in the state, are they keeping their expense revenue or expense costs down, and is that a factor in the rate of return?
It absolutely is a factor in the rate of return. All the numbers that I just quoted for all those time periods are all net of any fees that we've paid.
But I mean, is that an advantage of the
And
public
it is,
pension system?
and it is one advantage. It is an extreme advantage for CalPERS and other California pension plans, but I'll just speak to CalPERS, in our public asset classes. So the management of our global equity and global fixed income portfolios, we have investment professionals trading and managing those portfolios in Sacramento. That represents 67% of our overall portfolio, and our internal cost to manage those assets, I think 67% of $300 billion is a lot of assets under management, is less than 1 basis point, which compares quite favorably, incredibly favorably, to the private money management business. So that is one of the great advantages. Where we don't have as much a comparative advantage is in acquiring external management advice. And there, CalPERS has been quite good at negotiating the best costs that we can, but it's a competitive marketplace, and that's an area that we've spent quite a bit of time over the last 5 years in lowering our costs of hiring external managers, bringing more and more assets internally. CalPERS is one of the leaders in the United States in the percentage of assets that are managed in-house.
But at some point, going outside is actually a part of diversification of risk. So it's like you've got, but there, I just think it's important to recognize that our pension funds have a tremendous advantage, because that's part of why you get the rate of returns that are higher than what people expect.
Yes.
Any other comments or questions from committee members? Great. Thank you, Mr. Eliopoulos, Ms. Stossbaugh, Mr. Brown. Thank you for your participation and your leadership. Our next panel is the State Association of County Retirement Systems, or SACRS. We have Yves Sherry, President, Richard Stensrud, Chair of the SACRS Legislative Committee, and also Chief Executive Officer of the Sacramento County Employees Retirement System. Thank you for being here. Welcome.